Hi, this is Jim Cunningham. We're going to talk about Prop 19 in 2024. So Prop 19 was passed a while ago, and for a lot of people, they weren't happy with it. Some people are happy with it. There's some good stuff in there. There's some bad stuff in there. We're going to talk about the good and the bad, and I suppose the ugly. This is a disclaimer. I'm a lawyer. I'm talking, my lips are moving, words are coming out of my mouth. There's no attorney-client relationship. When I say you, I'm not necessarily talking, I'm not talking to you. I'm giving you legal advice. I'm just giving an example so that you can understand this concept. And Prop 19 is a multi-layered initiative that was passed in California. So Prop 19 in 2024, what is going on? And things did change. 2024, it's a little bit different than it was when it was passed in 2019. So some of the numbers have changed, and we'll talk about that. And Prop 19 was passed by ballot initiative in California. So way back when the railroads controlled everything, early 1900s, I believe it was 1909, the people of the state of California said the government's corrupt. We need direct voting. We need a proposition. So in our state, in California, people can vote on certain things. And this was a ballot initiative. So it did not go through the legislature. This is something that was sponsored by the California Association of Realtors and passed 51-49. So it was very slim majority. And it became effective February 15, 2021. What this did is this brought a really cool thing on the one hand, which is if you're 55 or over, or the victim of a wildfire or other natural disaster, you can transfer your property tax base more than once. You can transfer it 3 times and anywhere in the state of California. So if you live in Southern California, you want to move to Northern California or vice versa, you can move your property tax base. And we'll talk about what that means. And that really does save people who are older or a victim of a wildfire natural disaster. It does save them on taxes. Well, here's what, the government giveth and the government taketh away. What they took away was what we had, a very expansive and a very broad parent-to-child reassessment exclusion. Now, that's a lot of words to put out there. Parent-to-child reassessment exclusion. It's kind of a triple negative in there, in a sense, or double negative. So reassessment occurs when property transfers by sale, gift, or death. What does that mean? If you sell a piece of property to somebody, walking down the street, some stranger, and you get money and you sign a deed and it gets recorded, that's a sale. When that sale occurs, that is what is called a change in ownership. That's pretty obvious, right? I own it and I sell it to Bob and Bob owns it. That's a change in ownership. It's not, kind of Captain Obvious stuff. Gift, if I give my kid a property, so if I sign that deed and give it to my kid, that is also a change in ownership. And the one that really nails people, quite frankly, is death. Death is a change in ownership. So death has a lot of consequences legally. I mean, number one, you're dead, right? And someone else is going to get your stuff. And we talk about that a lot in my book, Savvy Estate Planning, what you need to know before you hire the right lawyer. But also, people don't really think about this. So, mom died, it's in mom's estate. That is a change in ownership. So if mom dies on a Tuesday, that is a change in ownership, and that property gets reassessed as of her date of death, unless that transfer is not a change in ownership or there's a reassessment exclusion. So it's going to get reassessed. Now, it's not a change in ownership if it goes to a spouse or a registered domestic partner. It's not a change in ownership if not more than 50% of an LLC goes to a single person, right? Or more than 50% of an LLC transfers in other cases. We'll talk about that. So sometimes what you may think of as a transfer or what you may think of as a sale, gift, or death sometimes does not result in a change of ownership and therefore not a reassessable event. So we're going to unpack that. Now, this is a 3-time transfer that Prop 19 allows. This is in addition to your Prop 90 base year transfer, which was so potentially you could move 4 times. I don't know if whoever is over 55 wants to move 4 times. I don't even know that I have another move left in me because we have a lot of stuff as we get older. So what are the current Prop 19 initiatives? The current Prop 19 initiatives are going absolutely nowhere. So I'm sorry to say the Howard Jarvis Taxpayers Association, the second attempt to get a ballot initiative on the ballot to take away the really bad parts of Prop 19 when it comes to parent-to-child reassessment exclusion. They got almost 560,000 signatures. They needed a lot more than that. And so it will not be on the November ballot. There are some people who hope that the state legislature, which is supermajority controlled by Democrats, and I'm not saying this politically one way or another, some people hold out hope that the legislature will somehow give a gift to people. That's not going to happen. Our Sacramento office is about 5 blocks from the state capitol. And I can tell you, I don't think it's going to happen. So you can kind of hear the loudspeaker. We're raising taxes. We're keeping taxes high from California. And that's just not going to happen. So I think we're stuck with this. There may be an initiative in the future, but they are going to need a lot of signatures. So what is a change in ownership? Very important. Change in ownership is when reassessment occurs. Reassessment does not occur if there's not a change in ownership for our purposes here, right? This is a sale, gift, or death. Revenue and Taxation Code Section 60 defines change in ownership as meeting a 3-prong test. All 3 prongs have to be met, which is a transfer of a present interest in real property. So if you say, hey, I'm going to give my kid this property in 5 years, that's not a change in ownership because it's not a present interest. They get it in 5 years, including the beneficial use thereof, which is typically, you can think of that as income. Certainly, you know, the right to exclusively occupy the property and the value of which is substantially equal to the fee. So if that's some legal jargon, a fee interest is from sort of old Anglo-Saxon England where people would infeft land. They literally would pick up dirt and press it into someone else's chest and say, I infeft this to you and your heirs. You get this property and I don't have it anymore. And then there would be a group of people around and they would see it happen. And that's how they recorded in the sense of remembering a land transfer. So that's what fee means, is to infeft property, an Old English word. There are 2 cases, Pacific Southwest Realty versus County of Los Angeles and Steinhardt versus County of Los Angeles. And this is where this second one's really important because in law, when we do what we call advanced planning, which is using irrevocable trusts, sometimes you can make a gift of property if you keep a limited power of appointment. And I'm getting probably a little technical, but if you create an irrevocable trust and you retain the right to say where that property goes when you die, that gift is not complete under state law and under federal law. So it's included in your estate. That change in ownership does not occur until that limited power of appointment lapses, which is either at your death or you release that power of appointment. So a fine point, but this is really important to understand. If you are a wealthy individual and you will be making gifts to your children, because we have this other sunsetting of the death tax exemption, right? It's $13,610,000. That's going to get cut in half in 2026. Sometimes people will use this planning strategy. So you really do need to pay attention to the property tax implications. So some examples on what a change in ownership is. Owen sells Greenacre to Abel for $1 million. That's pretty obvious. That's a change in ownership. So that is a triggering event where the property will be reassessed and Abel will pay, under the California Constitution, 1% of the fair market value of the property as of the date of purchase. Now, sometimes your property tax bill is a little bit more than 1%. That's because maybe your locality has passed some type of tax measure to add to the property taxes, and you also have parcel taxes. You know, vector control is going to ding you for $55. Those are the mosquito people. So you might have a library district or a high school district, right? So there are these things that are added on. So, you know, before you buy a piece of property, if you're concerned about property taxes, you may want to look at how property is taxed in different neighborhoods, and literally it can be neighborhood specific. Owen leases Greenacre to Abel for a term of 20 years with 3 5-year options. That's a change in ownership. Now, a lot of people may not catch this. If it's a lease for 35 years or more, and a lease for 35 years or more is defined as a lease plus all the extensions, that is a change in ownership. When that lease ends and it goes back to Owen, that's another change in ownership. So very important to pay attention if you're doing long-term leases. You know, some people say, well, I'll just do a long-term lease and that'll get around the Prop 19, parent to child reassessment exclusion. Doesn't really, you know, if it's more than 35 years, it's not going to be working. So mom gives family home to daughter. So here you go, honey. Here's the family home. That is a change in ownership. Now, whether the property will be reassessed or whether the property taxes will go up depends on values. It depends on whether the daughter moves into the home, and we're going to cover that on the parent to child reassessment exclusion. So all of these changes in ownership. Well, let's look at understanding Proposition 19. So Proposition 19 requires an understanding of Proposition 13 and an understanding of Proposition 58. So to understand why we have a problem, why we have this problem from a law that was passed in 2020, we have to look at 1978 and 1986 law. So if you're watching this video, this is a picture of me in front of my parents' condo in Ventura. So that's my parents with his pipe and my mom with their cigarette. They would keep the windows rolled up, and it's probably child abuse in 2024. But anyway, that was the 70s, right? So mom and dad bought a condo in Ventura for $24,000. And I will tell you, for you young people watching this, you go, oh my gosh, I can't believe how cheap that was. Like it's like a used car is $24,000. Well, people didn't make a lot of money in the early 70s or the mid 70s. So my parents bought this property for $24,000 and moved out a year later. The property is now worth $600,000. So condos have appreciated, right? Property's gone up on average 6.2% a year for about the last 40 years. But the assessed value is $65,000. And the reason is property that is protected under Prop 13, your taxes can only go up 2%. So if you go back to the 1970s, that property that's now worth, $600,000 is not paying $6,000 a year in property taxes. It's paying $650,000. So 1/10 the property tax. So I view this as a very important property, right? That you would want to keep, right? If you have it and you want to pass it to your children, right? So if this is a rental, then, if you're paying $5,500 less a year in property taxes, that goes right to the bottom line, that goes into your pocket. So in the 1980s, what happened is, so that we had Prop 13 in the 70s, and in the 80s, we had a Prop 58, which let the kids keep the parents' low property taxes. Now, there were some limitations on this, and it was limited to $1 million per person. So per couple, theoretically, $2 million. So they could transfer up to $1 million in assessed value. So your market value could be 10 million, but you could transfer assessed value of $1 million and the property's not reassessed. Now that is incredibly powerful. And when I became an attorney and started practicing in the early 90s, and for many, many years, this was just normal. Parents would pass away, leave the property to kids, the property would not be reassessed. Well, I think what happened is people, they had a problem with this, okay? Because if you sell the property to somebody else, what happens? So if my parents decide to sell the property in 2024, another family buys that same condo. It's worth $600,000. It was taxed as if it was a $65,000 asset with my parents. But what happens is when a new family moves in, they're reassessed, and that tax bill jumps from $650 a year to $6,000 a year, and people do pay this. So somebody living next door might be paying almost 10 times the property tax bill that their neighbor is paying, right? Some people view this as unfair. Some people view this as a property right. I got in. Why should I pay higher taxes? I'm not getting into that debate, okay? I'm just telling you that this was the old law. So people are really upset when this was taken away. So if you think about it, what is $5,000 a year worth? Well, $5,000 a year might be worth, I don't know, $100,000. It's like the equivalent of having 100,000 because you'd be getting 5,000 in interest, like on a CD. So it's a very important and a very valuable property right now. The reason the property taxes went up is because the change in ownership. This is every year. That $650 bill goes up 2% a year. So 2% of 65 is $13 a year. 2% of 600 is 120 a year. So 13, 120. Those taxes are going up almost $100 more every year. So over time, it has a cumulative effect. So when inheriting the family home, is there reassessment or no reassessment? It's almost like a game show, right? Reassessment or no deal or no deal, right? Let's look at the family home. The family home, and this was changed in 2023. So this is a new number really for 2024. And the reason I say 2024, even though it was a year ago, is a lot of times people are not filing this until a period of time has elapsed. Mom and dad passed away. They get around to filing their moving into the property and filing paperwork. So this number was $1 million when the statute was passed in 2020. And the statute said in 2023, it would be adjusted based on what homes are selling for in California. So right now, if the property transfers February 16th, 2023 and later, the reassessment exclusion is $1,022,600. Now, I'm explaining what this reassessment means. Meaning you just on a very high level, if the home is $1,022,600 or less, there's not going to be a reassessment. Now, if it's reassessed, we'll get through an example I'll walk you through that. So it's a partial reassessment if the property is worth more than the $1,022,600 plus its current assessed value. And I'll give you an example. A little complicated. When this first passed, it was very confusing. It took me quite a while to even understand what this meant and how to work with the materials, but we have an example that'll walk you through it. This is very important. The property, and this was clarification from since the initiative passed, the property must be continually used as a family home by an eligible transferee, meaning a person who received the property, a kid, or subsequent kid of a kid, in order to maintain the intergenerational reassessment exclusion. So this is a very common question. Okay, so mom and dad die, I move in within a year, I file my paperwork. What if I rent the property out 2 years later? You lose that reassessment exclusion, okay? Now the mechanics of it, kind of a mystery, but that's what the statute says. You lose it, and it's a self-reporting thing. So let's look at an example. If the fair market value of a home exceeds the sum of the assessed value plus $1,022,600, anything over that is partially reassessed. Let me say this another way. If whatever the tax bill shows, whatever the value of the property, because every tax bill will say this property is worth a certain amount of money. If that dollar figure on your tax bill plus $1,022,600 is less than the fair market value of the property, there will be a partial reassessment, a proportional reassessment, this little itty bitty, not full reassessment, but partial reassessment. So a home has a base year value, a factored base year value, meaning the base year value is you buy it. You know, my parents bought this condo for $24,000. That's the factored base year is the $24,000 plus the 2% a year. These are the technical terms they use. So the parent dies on March 8th, 2024, which happens to be the day we're recording this. And the property is worth, has a base year value, assessed value of $425,738. Now that's an odd number, but it's going to make sense when we add them together. The property is inherited by a child, and the home was the principal residence of the parent, and the date of death fair market value of the home is $1,750,000. And for those of you who aren't familiar with California, you might look at that house and go, that house is $1,750,000. Yeah. So the form to file is a BOE 19P, as in Papa, so as in parent to child, Board of Equalization 19-P as parent. It's a parent to child reassessment exclusion. And so what happens? How does the math work? So what we're going to look at is we calculate the sum of the taxable value, and it says $1 million. It should be $1,022,600. That million has been adjusted. So $477,400 plus $1,022,600 is $1,005,000. So what this means is $1.5 million of the value of that home is not going to be reassessed. So that means $1,005,000 can transfer to the child without reassessment, because that's the sum of the assessed value and the reassessment exclusion, or the coupon amount that lets you escape reassessment, right? Lets you escape reassessment of $1,022,600. So you have to look at the fair market value, but let's just say the property went up, since we've been talking, it went up to $2 million. So if the fair market value is $2 million, minus the $1.5 million that can pass tax-free, okay? So $2 million minus the amount that can pass tax-free, and the amount that's passing tax-free is the base year value of $477,400 plus the $1,022,000. That's $1.5 million, but the home's worth $2 million. The home is worth more than your coupon plus your assessed value. The difference between the coupon plus the assessed value does get reassessed, and that $500 is added to your base year value, meaning is added to the current assessed, or the assessment that mom had. So that difference of $500 is added to the $477,000, and then you get a new assessed value of $977,400. Now, if this is horrifically confusing to you, you are not alone. You are in good company, because lots of lawyers call me and they're like, Jim, I don't understand this stuff. Can you help me figure it out? And just understand that this is a $2 million home. And the base year, the $477,400 is added to the $1,022,600, and the sum of that is $1.5 million. But because the home is worth more than the sum of the coupon amount plus the current exemption amount, the property, there is $500,000 added to the value of the property. So the taxes go up $5,000 a year. So they were $4,700 a year. Now they're going to be $9,700 a year, right? So if you don't get that, you can go rewind this, or if you're watching this live, you can watch this on our YouTube channel. So Prop 19 allows to transfer your Prop 13 tax base to a new home up to 3 times in a lifetime. And this applies even if the property is of a higher value. So this is different than Prop 90. So the Prop 90 was equal or lesser. And if you waited a year or two, you might get 105, 110%, a little helper in there. But if you buy replacement, even a more expensive one, you can carry over at least part of your reassessment exclusion. And we'll have some examples here. This applies to people over age 55, severely disabled, and victims of wildfires or other natural disasters. And you must, this is really important. This has to be a sale. The property must be 100% reassessed. So you cannot give the property to your kids and then move your property tax base. That's not going to happen. The form that is filled out asks what is the sales price. So you got to pay attention to that, right? And 100% of the property has to get reassessed. So if you sell 50%, 100% of the property is not being reassessed. So this is something you probably should get some advice on. This is really important. And as you see, the numbers can be kind of high. So sale, and you have to file your form within 2 years. So let's have an example of downsizing. Abel and Baker buy a home in Pasadena and I believe this is in those little Craftsman home, whatever it's called, the Craftsman home area in Pasadena, north of the 210. They buy that home for $200,000 in 1980. Well, today it is worth $1.2 million, but it has an assessed value of $478,010, and that's $200,000 plus 2% a year, going back to 1980. Their property tax bill is $4,780. Now, in reality, if you live in Pasadena, you would say, well, it's my bill's not $4,780, it's $6,200. It's because it has those add-ons, the vector control, the high school district, whatever it is. Abel and Baker are paying this property tax of $4,780. Abel and Baker sell the home in Pasadena and buy a home in Roseville in Northern California. So this is somebody going from the LA area to Northern California for $900,000. So what happens is there's no change in their property tax. They can port or move their property tax assessment to the new $900,000 home. It's not proportionally reduced. They can just take that $478,000 assessed value. So they'd be paying $4,780, not $10,000 a year. So that's saving them about $5,000 a year. So this is pretty cool, right? I mean, this is really great. And a lot of our clients, it may be a spouse passes away and the surviving spouse wants to move closer to the grandkids or a child. And this really does help people move. Of course, we're not talking about capital gains tax issues. We can cover that. We're covering that, I think, on our next webinar. So upgrading, let's say Abel and Baker, they go, we don't want to move to Roseville. We have always wanted to move to Carlsbad. It's a little hot in Roseville in the summer. It's east of Sacramento, and it's very nice in the evening, a little warmer during the day, but they go, Carlsbad, it's just so beautiful, the flowers and the ocean, and it's just really great. So Abel and Baker have their home in Pasadena that is worth $1.2 million with an assessed value of $478,000. They sell the Pasadena home and buy a Carlsbad home for $3.2 million, right? Because Carlsbad is more expensive than Roseville. Newsflash, right? The first $1.2 million, because it's the sales price, right? The first $1.2 million is taxed at $4,780. The difference of $2 million is taxed at 1% or $20,000 a year. So the taxes do go up, but they go up to $25,000 instead of $32,000. So let me say, so this saves $7,000 a year. So let me say this another way. You can go down in price and keep your property tax. You can go up in price, but you only pay the difference from your sales price of the property you're relinquishing or the property you're selling, the difference between that sales price and the sales price of your new property. So these are sales, right? The property has to be 100% reassessed when you sell it. Again, you can't give it to a kid or sell it to a kid and they claim a reassessment exclusion. So there are some limitations on this, and it must be a sale. So there are some strategies out there potentially where if you're trying to move, could you sell to an LLC? Potentially, we've successfully done that strategy to essentially have that property reassessed and port over your assessed value to a new home. So not exactly easy stuff. And people do get nervous on this and they're like, I need help filling out the form or whatever it is. Or they need some more tax planning, because if you sell the $1.2 million asset and your basis is $200,000, you have $1 million gain. If Abel and Baker are married, they can exempt $500,000 in gain, but they still have another $500,000 capital gain. So there are some strategies to mitigate that. So Prop 19 takes away the parent-to-child reassessment exclusion. What does that mean? Well, I mean, I guess the legal term is Prop 19 guts Prop 13 for real property other than the family home. The sort of parent-to-child reassessment exclusion is Prop 13 58 combo, this powerful tool of Prop 13 or powerful tax benefit of keeping your properties low, keeping your property taxes low, combined with Prop 58 to then transfer that to your children, that's gone. It's over. Stick a fork in it. It's done. It's not, whether it comes back or not, I don't know. But I would not rely on the state legislature to cut taxes. Let me just put it that way. I don't see that happening in the near future. The parent to child and grandchild, by the way, there's a limited grandchild exemption. So if both parents have passed away, you can go parent to grandchild. So those grandchildren are treated, but both parents have to be deceased. And this is now just limited to the primary residence and family farm. And we'll talk about the family farm in other slides. Other types of real estate are reassessed to death. So vacation home, if there's no homeowner's exemption on it, rental property, industrial, commercial, those are all getting reassessed, right? So pay attention to how your leases are written, right? If your tenant is not paying your lease, if you have what's called a gross lease and the property's reassessed, you got to pay those taxes, and the rent's not necessarily going up if you're locked into a lease. So how do Prop 13 taxes work when a parent dies leaving the property to a child? It gets reassessed. That's it. Family farm reassessment exclusion. This is something that does affect people in a big way. I would say not everyone has a family farm, but for those of you who do have a family farm, it can affect you in a big way. So it is very important. A change in ownership does not include the purchase or transfer of a family farm between parents and their children if it's within $1,022,600, okay? Family farm is any real property that's under cultivation or being used for pasture or grazing or to produce any agricultural commodity. So pasture, grazing, agricultural commodity, rice farm, strawberries, walnuts, almonds if you're in the Sacramento Valley, almonds if you're in the Central Valley. Those are all farms, grazing land, right? Timber falls into the family farm category because it's produces an agricultural commodity. So agricultural commodity is any and all plant and animal products produced in California for commercial purposes. But wait, there is more. It applies separately to the transfer of each legal parcel that makes up the family farm. So you can thank the California Farm Bureau for this. When Prop 19 was passed, they worked in the definition of a family farm as a per parcel basis. So each parcel is deemed to be a family farm, except for a legal parcel containing a family home. That falls under the family home exception. So that's a different one. So if there's a family home on it, then you got to use that family home exemption. And that qualifies separately under our parent to child reassessment exclusion that we've discussed. So let's look at an example. We're going to look at two farms of 320 acres. The first farm of 320 acres has 8 parcels of 40 each. This is very common to have parcel sizes of 40. 640 acres is a square mile or a section. 320 acres is a half a square mile or half a section. Each parcel is worth $1.1 million. So the total is $8.8 million. So 8 parcels, each worth $1.1 million. Fair market value, $1.1 million. Each parcel is assessed at $100,000. It's because the parents bought it a long time ago, right? When farmland, in the 70s, when stuff was 10 times cheaper, right? So each parcel is assessed at $100,000. That means it's a total of an $8,000 a year property tax bill. So what you have here is 8 $100,000 parcels, 8 parcels assessed at $100,000. So that's $800,000. This is where I'm going with math. $8,000 a year is the total tax bill. The exemption is $1,022,600 per parcel. So what you do is you take your $100,000 exemption, you add the $1,022,600. That's less than $1.1 million because the sum of those numbers is $1,122,000. The 8 parcels go to the kids, no reassessment. Now the parcel has a family home valued at $900,000. There's less farmland, so it's not worth as much. That passes free of reassessment. Okay. So in this situation, because there are 8 parcels, 320 acre farm, the $8,000 a year property tax bill stays the same. Same farm, except it's a single parcel, right? Single parcel of 320 acres. Your taxes are going to go up $69,000 a year because that single parcel is covered under the family home exemption because there's a family home on it. So it's as if you had a family home worth 8.8 million. So let me walk you through this. The assessed value of the parcel is 800,000. It's a 320 acre parcel. It is worth 8.8 million, which is approximately what it's kind of worth, 320 acres. You have $1,022,000 600 exemption. The parcel is reassessed at the transfer. The assessment jumps to 7.7 million. The taxes go up. And this reassessment is due because it's a single parcel. So this is nuance. This is where you need to. So if you own a family farm, you're going to want to look at your parcels. What is the value of each parcel? Can you divide properties into separate parcels to somehow, get under the exemption amount? I don't know. It's probably case by case analysis. Whether you can do it or not, maybe not. Who knows? Let's look at some available strategies to keep your property tax reassessment. We do have some questions and we'll answer those. Go ahead, if you're watching this on YouTube, by the way, go ahead and put questions in the Q&A. There's actually a comments field. I mean, on the YouTube, go ahead and put those in because we do answer them. But we're doing this live and we do have some questions. By the way, if you want to have your questions answered live, come to one of our webinars. Go to our website, CunninghamLegal.com, register for a webinar, and then you can ask your question live. So let's look at the co-tenancy exclusion. This is kind of a big deal. So the co-tenancy exclusion was in 2013. Now, this is before marriage equality, when we went through that phase of who could marry whom. That's all been settled. That's sort of yesterday's news. And what happened in California is you had people who either were not married but living as a couple, or could not get married and were living as a couple. And one person would pass away, and then that survivor would get reassessed. If they owned it 50-50, the survivor would get reassessed 50%. So people had a real problem with this. Look, this is the family home. We're a couple. And so California came out with a co-tenancy exclusion. So this is originally designed for essentially a couple, cohabitating couple. It is not limited to a cohabitating couple, okay? This was not used with parents and children because we had the parent-to-child reassessment exclusion. We didn't need it. So under the co-tenancy exclusion, the two people who are on title must own 100% of the property as tenants in common or joint tenants, okay? So, could it be in your living trust? Yes. But it's tenants in common or joint tenants. Trusts cannot own property as joint tenants. And so that's why we put tenants in common. So if trusts each own, like, for example, 50%, each trust would be a tenant in common with the other, but you can't have trusts be joint tenants, because what joint tenancy says is the last person living of the two people. So two people, one person dies, the last person standing gets the whole property. Now, kind of a tax disaster. We talk about that in other webinars, but it's a different way of holding property, and we do cover that in other webinars. You must be owners of record for the 1 year period immediately preceding the death of one co-tenant. So two people are entitled. It could be 99.1%. It could be 50-50, but only two people can be on title, and they have to be owners of record for 1 year prior. It must have been the principal residence of both co-tenants for the 1 year period immediately preceding the death of one of the co-tenants, and the transfer must occur to the death of one of the co-tenants, and the surviving co-tenant must get 100% ownership in the property. So if it's 99.1 and the person owning 99% dies, the person who owns 1% has to get that 99% in order to avoid reassessment. And by the way, this does work. So what do you do? So if there are two co-tenants, when one person dies, the surviving co-tenant must sign an affidavit under penalty of perjury, affirming that he or she continuously resided at the residence for the 1 year period immediately preceding the transfer of that co-tenant's death. And it is not available if another exemption is available, such as the parent-to-child reassessment exclusion under Prop 19. Now, I put an asterisk on here because we did get confirmation from the LA County assessor that the child can use the better of the two exemptions, the family home or the co-tenancy. So there's something in the law that says if one exemption is available, you have to use it. But this parent-to-child reassessment exclusion, this Prop 19 one, came after this one. So there's a legal technical thing in there, and I don't want to get bogged down in the weeds, but we did ask LA County. We got confirmation in an email. By the way, if you work at LA County in the assessor's office and this is not correct, please reach out to us, team@CunninghamLegal.com. Please correct us. We'll fix it. But right now, hey, we have an email from the LA County assessor saying we can choose one or the other. Now, we didn't go to the Santa Clara County assessor or the Alameda County assessor, but because LA County has about a third of the population, and it took a while to get a response. So, there's another issue on this is, what if you don't you have this parent to child reassessment exclusion, but you're capped at $1,022,600 if the difference between the base year value plus the coupon amount of $1,022,600 is more, right? It would stand to reason that you could use the co-tenancy exclusion and the parent to child reassessment exclusion. And I think this is why LA County said, look, you can use either one. We don't really care because the property's not going to get reassessed anyway. Okay. So again, if you're an assessor or you're at the Board of Equalization, this is a wrinkle that it's kind of an open question of law. And when our clients have done a strategy using this, we tell them, look, this is an unsettled area of law. We're recording this in March of 2024. There's no definitive answer one way or another. So it's the world we live in. So let's look at an example. Grandma owns a lake house and it is her primary residence. Grandson moves in to take care of grandma, and the lake house is grandson's residence, and grandson's mother lives across town. Grandma adds grandson as a joint tenant. There's no reassessment if you add someone as a joint tenant, if the original person stays on there. Just a little FYI. I'm not saying that's a great strategy to use because she has made a gift to grandson of 50%, and it kind of is problematic for capital gains tax purposes, but I'm trying to teach a concept here, so just go with me. Grandma adds grandson as joint tenant, no reassessment, or grandma adds grandson as a tenant in common for 1%, resulting in a 1% reassessment, okay? And the reason the mother lives across town, so there's no grandparent to grandchild exclusion, right? That's why that's in there. Grandma dies, and under grandma's trust, grandson inherits a lake house, no reassessment. Now, this requires artful estate planning. Why? Because maybe the mom wanted the lake house, right? And grandson's taking care of grandma. So maybe we work through the estate plan where son could add mom as a joint tenant, right? Maybe sell half of it to mom as a joint tenant. And then when mom dies, grandson gets the property, no reassessment. So it's a multi-layered strategy. You have to be looking at different exemptions, and you have to be looking at death taxes, capital gains taxes, potentially income taxes. It's not an easy analysis. And the reason I mentioned lake house is some of our clients, they may have a home in the family that no one in the family, even if they were all put together, could even remotely afford buying. You know, lakefront Lake Tahoe, it's 10 million bucks or whatever it is. There's no way they can afford it, but great grandpa got it, a long time ago. And that's the sort of the family home. And these are the kind of trophy personal use assets that we often see in doing this planning. So how do you settle up with the other family members? I think that requires artful estate planning. What rights do the other family members have, right? Are they going to sue them because the grandson got the $10 million lake house? What are the tax issues? There's no answer here, but I want you to know, if this is you, there may be a path to avoiding reassessment. Now, you may not get everything you want, but understand that don't give up hope. I think it makes sense to investigate. So what else can be done after Prop 19? I would say that if you're going to buy non-personal use assets, right, and when you acquire that property, it's going to get reassessed, consider purchasing that investment property in an entity such as an LLC. Many times, if the owner of an LLC dies, reassessment can be avoided, or sells the property. Reassessment can be avoided if the property is originally purchased by the LLC or reassessed when it went into the LLC, so long as no one gets control or more than 50%. This is black letter law in California. There's a case that we're going to talk about, but it is very clear the LA County assessor did not like it. They appealed it for years and ended up having to reimburse the legal fees of the person that they were seeking to reassess. So LLC strategy, we're going to walk through that very, very important strategy. Well, the importance of an LLC being an original owner, it's really important, and it can be a really good thing. So what do I mean by that? So let's look at this case that we have, the Ocean Avenue LLC versus County of LA. Now, I don't like to get legal technical on these, but this is a really good case. And if you're interested in it, I would Google this. Michael Dell was involved in purchasing the Fairmont Miramar Hotel in Santa Monica. And so what happened is the original owner, so an investment consortium had this property. It was in an LLC. The LLC acquired the property. Then they went to sell it to Michael Dell and his family. And what happened is the LLC shares were sold in a way that it avoided reassessment. So in real estate transactions, something to bear in mind, is when it's a securities transaction, an LLC transaction, you typically don't see a title company or an escrow company involved. It is handled by lawyers. Sometimes it is handled by real estate. I'd say real estate professionals are involved, but it's fundamentally a securities transaction. So the dirt, when I mentioned in feffing, taking the dirt, picking it up, and transferring the dirt to somebody from me to you, in this case, you're transferring LLC shares. So the LLC is the owner of the property. And what has happened is the LLC shares are being conveyed in the background. They're being transferred in the background. So title doesn't change. This is really important. The title of the property did not change. It stayed in Ocean Avenue LLC. So what happened is the owners of Ocean Avenue LLC sold their shares in the LLC, and this avoided reassessment. So instead of selling the property itself, instead of the LLC selling the property to Michael Dell, the LLC owners sold their shares of the LLC to buyers where no single buyer acquired more than a 50% stake in the LLC. And this is the LLC that owned the hotel. So again, it's an LLC. Kind of think of it as like a bucket with some shares, right? So the people sold their shares, but the property stayed in the bucket, and the bucket went from the sellers to the buyer. But what was really transferred or conveyed were the shares, not the property itself. Under California law, a change in ownership that triggers reassessment generally occurs when a single entity or an individual obtains a majority stake over 50% or a change in control. So getting more than 50. So if somebody bought 51%, reassessment. If somebody got control over the property, reassessment. But since no one owned more than 50%, nobody had control, right? There were no controlling shares or, so voting and non-voting shares or whatever it was, pretty straightforward. Nobody had control, no reassessment. The court held that there was no Prop 13 change in ownership of the property held by a limited liability company when all its membership interests are sold. So the paper transfers, but not one person or entity gets more than 50%. So Owen creates Maple LLC. Maple LLC buys 123 Maple Street. 20 years later, Owen sells the shares of Maple LLC to Abel, Baker, and Charlie, each of whom acquire 1/3 interest. Since nobody got control or more than 50%, no change in ownership. By the way, Abel, Baker, and Charlie could be Owen's kids, right? So if you are building a real estate empire, if you are building intergenerational wealth, you really should take a look at creating and having an LLC buy the property, or when the property goes into an LLC, having it reassessed. The LLC becomes the original owner. Very, very powerful strategy to preserve Prop 13 when transferring property between generations. Well, what if you're not an original owner, right? What if you're like, well, that's great, but I created an LLC and I put the property in the LLC and it didn't get reassessed when it went in. Well, that's non-original owner LLC. So if this sounds horribly confusing, it is confusing to many people. You're not alone, right? You're in good company. A lot of smart people, very confused. So not being an original owner is not as good, but 49% is better than 0%. What do I mean by that? What do I mean by 49% is better than 0%? When people sell, give, or die with real property, that's a change in ownership. Transfers between spouses and registered domestic partners are not changes in ownership. Lifetime joint tenancy transfer is not a change in ownership if one original joint tenant is on title. So if I convey Greenacre to you and me as joint tenants, that's not a change in ownership. Now, I could sell it to you for 50%. I could give you it for 50%. My point is, it's not going to get reassessed because I'm on title. If you die and someone else, and I get the property, yeah, it's going to be, well, I mean, it wouldn't be reassessed. If I die, certainly it would be 100% reassessed. So long as no more than 50% of an LLC is sold, given away, or the owner of an interest, LLC interest dies, there's no change in control. So no one gets more than 50%, no change in control, no reassessment, than 0%. So let's look at an example. Mom has a beach house rental assessed at $500,000. It's worth $3.5 million. Mom gives 51% to son, and this 51% of the property is reassessed. So hence 49%. 51% is reassessed, so the taxes go from $5,000 to $20,000. Son puts his 51% into the LLC, and mom puts her 49% into the LLC. When mom sells, gifts, or dies, there's no reassessment because not more than 50% of the LLC's changed. So son could even inherit that 49% and not get reassessed. Son can buy it from mom, not get reassessed. Could she avoid the mansion tax? I don't know. This is a topic for another day. So I hate to think while I'm talking. It's kind of dangerous. So son saves $15,000 a year per year in property taxes. What about capital gains taxes? Just forget, we'll cover that in another topic. But what we're talking about here is property taxes. Now, I do want to say that sometimes people are so worried about property taxes. It's like the flea on the tail of the dog that's wagging the dog. If this is a rental property and you can pass the taxes through to your tenants, less of an issue. And it's always an issue because, it's higher operating expense on the building. But again, I think this is a case by case example. So mom has a beach house assessed at 5. Again, instead of giving it to son, we put it into something called a Prop 13 trust. Now, this we developed before Prop 19 became effective in February of 2021. It is a way of transferring property to your children because if mom gives the 51%, then son doesn't get an adjusted basis, right? Because it's not included in mom's estate. Well, we found a way around this. And for those of you lawyers who are watching, if you convey property to an irrevocable trust and the trust is a completed gift, that is a change in ownership. If the trust is written in a way to delay distribution, for example, by 6 months, Internal Revenue Code Section 2038 applies. And basically what 2038 says is if you create a trust and you say, the trustee has no authority to distribute assets for a period of 6 months following my death, that comes back into your estate because you are exercising control from the grave, like strings from the grave, right? You are usurping the trustee's authority. And under Internal Revenue Code Section 2038, that property comes back into the estate. Poof, you have an adjusted cost basis. Delaying the gift under this context does not make the gift incomplete for property tax purposes. And if you're even following this, kudos to you. There's Treasury Regulation 2511-2D saying that a donor's reservation of a power to control the time and manner of enjoyment does not by itself cause the gift to be incomplete. And this is really important because if it's an incomplete gift, it's not a change in ownership. So in this case, we want a change in ownership. We want son to be the owner. But then when mom dies, we want a full adjusted cost basis so that son maybe could start depreciating the property again. So a little esoteric, finished on a technical note. Thank you for watching. And we're doing this live and we have a lot of questions. I don't have my reading glasses on, so I can't see how many questions we have, but it looks like a lot. We have office locations in Northern and Southern California. If you're watching this on YouTube, please subscribe to our YouTube channel. It's a great way to stay up to date. We release videos typically every Thursday at 6 p.m. And next week, we have our next webinar is how to avoid and defer capital gains tax. Well, that's kind of cool. For those of you who bought NVIDIA a little while ago, you might want to watch this. So how to avoid and defer capital gains tax. There are avoidance strategies, right? And as well as deferral strategies. So tax deferred is almost as good as a tax avoided. Paying it later is better than paying it now. And if you're watching this on YouTube, please keep watching on YouTube because the next video is just going to seamlessly roll and you'll continue learning about all this fun estate planning stuff. Thanks for joining us.